Hello and welcome to another Macro Monday. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, here on the direct trading team, looking to give you some insight from our trading floor.
This week we'll be discussing the reaction to the Fed's 50 basis point cut last week. We'll look at China, who have cut the reverse repo rate 10 basis points this morning. And we'll also look at, is Europe in trouble? The German economy would say yes.
Yeah, we'll be looking at the all-time highs that have been re-established this week in the S&P and in gold. We'll take a quick look at crypto markets as there's been a bit of a recovery there. And as always, we'll be looking at some key charts and data throughout the previous week and looking forward to data coming out next week.
So let's start with the Fed's 50 basis point cut last week. The market was suggesting they'd go 50. The overnight index swap had 40 basis points priced in. They went the full 50. It did surprise some analysts, but then they were quite upbeat about the economy. Powell, Fed chair, said that the economy is strong overall. So they cut 50, but the dot plot also suggests another 50 basis points of cuts by year end, is what the central bankers are thinking at the Fed. 100 basis points of cuts next year and another 50 in 2026. That's faster than was previously signalled, but what I found particularly interesting is the Fed expect GDP to remain at 2% going forward over the next 2 years. And they think the peak of the employment or unemployment will peak at 4.4%, currently 4.2%. That surprised me personally, but it suggests that the Fed are going to look to be more preemptive in their cutting rates rather than after the event to weaker data. And one other point, the long run Fed's fund rate, they've raised to 2.9%. So the market's saying that the Fed's going to be much more aggressive at the front, but it's now pricing in stability further down the curve.
Yeah, absolutely. I mean, you know, looking at this with a bit of an overview, we knew that they were going to cut, they had to cut. Unemployment was creeping up. However, unemployment still, as we've said before, isn't at absurdly high historical levels. We know that there's always a lag when rate cuts come in to taking effect and seeing an impact in the economy. So having a bit of a deeper dive than just the 25 basis point cut is not particularly surprising. And I think it's fair to say some markets responded quite well to this cut.
Yeah, absolutely. Gold finished on highs of the day, as we've spoken about. The S&Ps breaking the all-time highs. We'll have that chart a bit later.
Yeah.
And we didn't see the bond prices, we didn't see yields falling aggressively at the back of the curve. So the market's seeing this as a sign of stability from the central bank. Interestingly, Bank of England was unchanged last week, so they're not being preemptive like the Fed. And we also had a 10 basis point cut in the reverse repo by the Bank of China this morning, again trying to kickstart their economy. If we look at the US data, what was interesting last week, we did have some data come out stronger than expected. Retail sales, industrial production, the New York and Philadelphia regional surveys and jobless claims all came in above expectations. Are expectations too low now?
Yeah, well, they've definitely adjusted, haven't they? So if we look at the jobless claims in the US and if we look at manufacturing indices, people, I think, are, you know, not necessarily outright bearish, but more bearish than they had been over the previous quarter or 3 month sort of term. So these newer rates are lower, and so to meet or exceed lower expectations isn't necessarily a fantastic sign, but yeah.
And interestingly, this afternoon we get the US ISM for both manufacturing and services, so that will be a good insight to the economy. One piece of data drilling into the Empire, the New York Empire, the new orders index within their regional Fed survey. This is quite highly correlated historically to the ISM new orders. So again, is this green shoots of recovery or is this one piece of outlying data? Again, we'll get a better read on that this afternoon with the US ISM data. One thing that got a lot of attention, one chart this week on the more bearish front is, as we just discussed, the unemployment rate is clearly trending high now. And it's broken above the 36 month average. So that's a 3-year moving average. Every time we've had this previously, there's been a recession. So you can see the market's in limbo here. It's pricing aggressive cuts by the Fed. Unemployment is trending higher, typically to levels seen with recession, but we are still seeing some data coming in above expectations.
Yeah, and unemployment on such a long-term basis, 3 years. This is a good indicator of what we've been saying for a few weeks now, that the middle American is being squeezed. However, looking at things and saying, oh, okay, well, this is going to be a forebearer of doom and gloom and hard times. It's not necessarily the case. And there are things that, monetary policy and also fiscal policy can do to mitigate this. So I think, as we've said, the Fed have tried to be preemptive with monetary policy in order to improve unemployment. And it will be interesting to see, from a more fiscal and governmental perspective, what will happen over the next 12, 24 months as we go into election season, and there is likely to be significant policy change in the US.
Excellent. And some data that did come out slightly weaker last week from the US. US home sales fell aggressively, the second lowest level in 14 years. So US existing home sales fell by 2.5% to 3.86 million in August. Again, the second lowest level in 14 years. And since January 2021 peak, home sales are now down 42%, marking the biggest decline since 2006 housing bubble burst. Clearly, mortgage rates are impacting.
Absolutely. And, the question now is, are housing sales going to continue to decline, or is this actually a good opportunity to get into the trade? So the headline this morning was that Legal & General and Schroders from Britain that are going to invest, hundreds of millions of dollars in commercial property in the US. This could be something that makes a lot of sense. If interest rates and mortgage rates are going to drop, then you could see a bounce back in the US sort of property market. However, at present, we've been in a high interest environment. Disposable income is on the decline. Mortgage rates are high. So this hasn't been a good environment to be a first-time commercial property or private property buyer. It's a murky picture as to what lies in store.
And it's an interesting point as well. Home sales, the number of sales has fallen, but house prices are still very high. Yeah. And what's typically knocks the pack of cards over is as unemployment rate goes up, people are then forced to sell. But again, it depends on how high the unemployment rate goes.
No, totally.
Unfortunately, there's no green shoots of recovery in Germany, and German data continues to deteriorate. Last week, German wholesale price index fell year on year, down 1.1%, so deflation there. That's just the wholesale price index, not the CPI. We also had ZEW, current conditions index, fell from minus 80 to minus 80.5. And investor expectations fell from, estimated to come in at 17, came in at 3.6%. So ECB's Casimir said the economic recovery has been disappointingly weak. And the Bundesbank has warned that the German economy could shrink again in Q3. That was last week's data, compounded this morning by the weakest PMI data in Germany for 7 months. The manufacturing PMI falls to 40.3, and the employment index here is now the weakest in 15 years outside of the pandemic. So raises the chances that Germany's in a technical recession. And the French PMIs this morning, also very weak. Services 48.3, manufacturing 44.0. This suggests that France is already in a recession. And again, these are diffusion indicators. So above 50 shows expansion, below 50 contraction. And we're seeing continued aggressive contraction here, particularly in manufacturing.
Yeah, and I think off the back of that, it's important to look at, power prices within Germany, and also looking at natural gas. And derived demand seems to be quite weak at the moment. Understandably, you've got PMIs coming in under expectation and looking weak. The German economy is faltering, and you're seeing power demand falling. Prices have been regressing, and I think what we're likely to see is a further degradation in prices for German power. Looking also at natural gas prices in Europe, the TTF curve has similarly come off over the past month or so. These are worrying signs for the prices outright. If you're long, whether you're long German power, whether you're long natural gas. The important role that this plays, though, in the macroeconomy is how this influences inflation. One of the leading reasons why I think the ECB cut last month was due to a reduction in German power prices. I think power prices came off notionally about 5.1%. This reduces the chance of reduces the inflation burden upon the German economy and subsequently the Eurozone economy. And therefore what you see is rate cuts. So things are ultimately, a balancing act. And what you may see if rates come off further in the ECB is an increase in, money put into, whether it be on the retail investor side or whether it be from commercial investors with lower interest rates looking to invest more and produce more using power. So you may see a rebalancing, but as things stand, I think this is a quite obvious sell.
Yeah, I think the euro is quite obvious sell as well, the currency against the dollar, because the US still has more cuts priced in over the next 12 months than Europe, and Europe economy is significantly weaker. And again, as we said, I touched on last week, the Fed is looking at the dual mandate and concerned about growth, but the ECB here is stubbornly sticking to their inflation mandate.
Yeah.
But I agree, I think there's more cuts to come, more aggressive cuts to come than's being priced in Europe, and the euro dollar will be trading significantly lower in the next 6 to 12 months. It'd be wrong of us just to focus on the negatives and the weakness, though, in Europe and the global economy. Let's pick up here on Poland. Here, Poland surging GDP per capita. Incredible growth here since 1990. Poster child of Europe, similar to what we're seeing in Indian economy.
Absolutely. I mean, the thing about Poland that I'm liking at the moment is how they've pre-positioned themselves to be, very long gold going into these all-time highs. But yeah, as we'll come to see, a lot of doom and gloom is around in the Asian economy, but India seems to be going from strength to strength, and I think equities are, building constantly, verging on all-time highs. So yeah, you have the examples in Europe of Poland and in Asia of India, of economies not all being totally weak.
I think what's unfortunate, though, is the Indian economy is relatively insignificant to global GDP compared to US and China. And in Europe, Polish economy is fairly insignificant compared to particularly Germany and France, which are the negatives there are completely outweighing the positives from Poland. China Tier 1 property index, now 28% off its highs. Again, a good chart here that highlights how aggressive the property market in China is falling. This, of course, the main store of Chinese household wealth. Another reason why we're seeing retail in China moving away from property into gold for their investments. Again, another positive on the global economy, Singapore electronics exports surge. They're rising at the fastest pace in 14 years. And again, if we look back at what we discussed last week, Taiwan, their exports hit a new high in August, up over 16% year on year. So we are seeing small signs of economic strength in the global economy. Unfortunately, again, it's being dominated by weakness in China, Germany, and again, big focus on US.
Absolutely. I mean, it definitely is worth looking at these positives, but perhaps giving them equal airtime does not, is not warranted, because the weak points that we're seeing in US housing, as we've highlighted, European PMIs, Chinese real estate, these are all signals of really weak economies. Having outliers being Poland, India, Singapore is a big economy, but having a 16% growth in exports. These are good signs, but not for the crucial economies to global.
Absolutely,
global
largely insignificant, the global economy.
Exactly.
Again, China and US account for 43%, just over, of global GDP.
Yeah.
If we look at the OIS pricing over the next 12 months, again, to highlight the market, even after the Fed's 50 basis point cut, is expecting another 187 points from the Fed. Well, the ECB, it's only expecting 159 basis points of cuts. Again, to me, that seems slightly mispriced. I think the European economy is significantly weaker, and we're going to have to see some catch up there by the ECB. Whether we see that priced, or you were to trade that via the OIS or the currency, I think the euro dollar, as I say, is a good sell at these levels. Another interesting one, New Zealand, 195 basis points of cuts priced in over the next 12 months, but only 98 by the RBA. We have an interesting chart on that soon.
Yeah, I mean, I think the Australian consumer confidence, the headline last week was that Australian consumer confidence is at 2-month highs, whereas in New Zealand, I think the picture is a bit darker than that even still, with Q2 GDP having to be revised last week. So I think that went down to 0.2%. So yeah, I think the New Zealand government definitely does need to cut further to really try and, well, not accelerate things, but mitigate damage and get the New Zealand economy back up and flying.
It's interesting, these are two very close trading partners, but the RBNZ were much more aggressive in their hiking and stubbornly stayed higher for longer to combat inflation, whereas the RBA were less aggressive in hiking, more, I don't know whether you say it, to protect the housing market. And hence now they're not needing to cut as aggressively from such high rates. Another interesting point, final point here, the BOJ hikes, of course, still priced here, but this has gone down from 25 basis points to 20. The BOJ had their central bank meeting last week and came out less hawkish. They've been particularly hawkish the last couple of months. They became less hawkish, and off the back of that, the yen's weakened. We do have that to discuss in a second. The 2-year yield, interesting here. The Fed cut 50, but you can see the 2-year yield has gone sideways over the last 10 to 15 trading sessions, but it hasn't broken back above resistance. So it's still trending downwards, the yield. People are buying bonds, even with equities and gold making new all-time highs. Just looking at the chart, I would expect this to continue trending lower. And it'd be amiss not to talk about the S&P making new all-time highs. Interestingly, this isn't being seen in the NASDAQ. The NASDAQ Composite Index has just failed to break the 18,000 level, or failed to close above it. The market likes rate cuts for now, but again, over the past 12 recessions, the S&P has gone down and the peak to trough average decline has been 24%.
Yeah, I mean, I think this speaks to, the rate cuts and the glee that was met with having the 50 basis point rather than 25 basis point cut. I mean, my Twitter or X feed was certainly rejoicing at 50 basis points. But, it does make sense for less money to be saved with these interest rates, and therefore money floods into things like equities, but also, as we'll come to see, crypto's had a bit of a resurgence over the past month with this basis point, with this interest rate cut.
Yeah, again, rate cuts are good for equities, but recession data, economic data isn't. So
absolutely,
it's again, the focus will be back on this afternoon's PMIs and then employment, which comes out at the end of next week. Gold, very briefly, a chart here. Gold making new all-time highs. Still support 2,466. It's trending higher. It'd be amiss not to discuss that, breaking new all-time highs again with the S&P. And then on to Bitcoin.
Yeah, so Bitcoin's still very much down on the year, but we've seen, down from the highs of the year. But we've seen a recovery over the past month. We hit 4-week highs on Monday morning as we're recording, with people putting money in from interest rate cuts. I would assume that would be the major explainer of the strength, but I suppose 4-week highs don't necessarily indicate that Bitcoin is all of a sudden a great investment, but it is what it is.
Interesting. Bitcoin trending higher, equities trending higher, bonds sideways, but longer term trend higher. It'd be interesting to see what gives. No,
absolutely.
A chart we highlighted, a about 2 months ago. Worth highlighting again here, we discussed Aussie Kiwi. Here, the yields, the white line shows the interest rate differentials between the 2-year interest rate swap yields. And you can see clearly the currency has some way to catch up. The correlation's clearly broken down. Aussie Kiwi suggests it should be trading 4 or 5 big figures higher. So expect Aussie Kiwi to trend higher over time.
And then, the graph that we're going to be looking at here briefly is diesel. So we've seen short positioning coming in on diesel, and it's very understandable as to why. You know, a lot of the global diesel consumption is out of the East and out of China. When you see bearish macroeconomic headline after headline in China, it's understandable to expect demand and prices therefore to come off. And in particular, we've been hearing a few headlines coming out of the Chinese government that they're going to be increasing mandates for electric vehicles, not only for day-to-day traveling, but also for trucking, which is one of the largest sort of sources of diesel demand these days. So over the past year, people have been getting increasingly, taking off length initially, but then increasing their short positions. So we're now at the most short net positioning on record of diesel. So hold on to your hats if you're a diesel consumer.
And that bears with last week's Brent. We had the biggest short ever in Brent,
Absolutely.
speculative short ever in Brent. And that market actually, when everybody's short, it takes new shorts to send the market lower, and we're not seeing that. So we're seeing a short-term bounce in Brent, but that's now going sideways.
Yeah, I would also say, with Brent, you're perhaps more at the mercy of geopolitical headlines. So, obviously the situation in the Middle East unfolding as it is, and continued headlines out of Ukraine and Russia. You will see that feeding in a bit into the Brent pricing. Diesel, I can't really say would be as affected as Brent. It still has geopolitical risk premiums in it, of course, but a lot of the diesel that is produced in the world is produced out of the East. If you look at the sort of grades of crude that are available in the East, they are more successfully producing diesel than Western crudes. So seeing these headlines out of China, I think, will probably be the primary factor in explaining the shorts.
And that's a great point as well. You can trade the diesel and these products as crack, so you take away the geopolitical risk there. You're trading purely the individual refined product as opposed to the
flat price outright.
Absolutely. Dollar yen, again, here, the interest rate differentials, we've seen that bounce. Dollar yen has bounced at the end of last week, with the BOJ firstly being slightly more hawkish. And also, of course, we had the Fed, they cut 50, they cut aggressively, but then they were quite hawkish on the back of that. So we've seen a turnaround in the interest rate differentials. That's beginning to push a little bit higher. And again, that's brought a bounce in dollar yen. That's got to be a bit of relief to the markets, because the carry trade unwind had been so spectacularly painful in the losses. Must be about 2 months ago now.
Absolutely.
And there's some relief there with the weakness in the yen.
Yeah, as this chart on the screen illustrated, but for any listeners of the podcast without the chart, we were in a period of significant divergence, and ultimately things are starting to converge again. So I think that speaks to exactly what James was just saying.
Which brings us on to chart of the week. Last week we didn't want to highlight a chart because of the volatility going to the Fed meeting, but this week quite happily to look at the US 2s 10s yield curve. Now this was inverted for over 2 years. Always the theory was an inverted yield curve heralds a recession, and what we've seen now, it's started to steepen, it's turned positive. And the reason I think this trend continues is, firstly, we know the Fed is going to be preemptive in cutting rates at the front of the curve, so that brings the 2-year yield lower. But if they're going to be preemptive and they don't expect GDP to fall below 2%, and they think unemployment will peak at 4.4%, then we'll start to see fears of inflation coming back, which would steepen the back of the curve. So I think the Fed's move here is affecting both parts of the curve, the front lower, the back higher. And again, we'd have a target of 75, which was the previous swing low, and then the peak from 2 years ago, 158. There would be targets to the top side and a stop loss at -20. But to me, it seems like this is now trending pretty clearly. And again, it's another market that trends pretty well.
Yeah.
Which brings us on to this week's data. Again, today, US flash PMIs. That's going to be an interesting read on the economy. The market will be focusing on that. That's probably the key data of this week. Tuesday, we have US consumer confidence and the Reserve Bank of Australia's rate decision. Thursday, core PCE inflation out of the US, and that's all for this week, I think, on the data front.
Yeah. No, it should be an interesting week, and as you mentioned as well, the week following we'll have a better understanding of the employment statistics, but it's all to play for, as it always is.
Yeah. So hopefully you've enjoyed this week's podcast, and we'll see you next week. Thank you for joining us, and do please like and subscribe.
Thank you very much.